These are the deals where you can just set it. You're making a good amount of money. If you did nothing else, you're in a good spot.
Yeah.
And then you can start picking away at it piece by piece to increase the income. It's a good deal.
That's the one thing that I've seen over, the last 3-4 years is the people that are actively buying and still doing that is they're taking stuff a little bit safer. They're not over leveraging. They're not getting their hands, they're not going too far into it when there was uncertainty. So have this and just slowly work at it. If you want to get into the multifamily space, but you don't want to do something complicated, something like this is perfect.
Welcome back to REI Hot Seat. Andrew Hines here with Brad McCrae and Dave Hulshof, and we are going over an on-market deal, which we don't usually do. So we just got Realtor.ca pulled up here, and this is a pretty cool looking deal. We're going to go over high level what it is and why you might like this, why this might be a building that'd be worth taking a deeper look at. So
thank you for having us. And the conversations that we have as agents helping investors find multifamily deals like this is, if it's not off market, I don't want to see it. And a lot of what transacts in this space that's 6 and above is off market, but that doesn't mean you don't have good deals on the market. And so we just wanted to pick one to show that you still can find things that are good, that are worth buying, that have potential, that are right on the MLS.
Yeah. So a couple of things, because we just had some tech difficulties. We're doing this sort of for the second time. So we're really well versed on this one. This doesn't look like your typical multifamily building. It's kind of more like a row house setup. And it looks kind of quaint. Like it's, got that beachy vibe, and you got some land there, which you don't see in town very often.
Exactly. Yeah. So I'll kind of just jump into this. So this is in Wasaga Beach. For anyone that knows Wasaga Beach, it's on obviously Mosley Street, which is the main street that kind of connects everything close to the beach. And it's just a little bit down from the beach and steps from the casino that was just built, which we found out about in this second take.
25,000 square feet and no tables.
No tables, we now know.
So I know we're going to look at let's look at some photos first. There's no photos of the actual units here.
No, there's no photos of the unit. So it is a corner lot, just under half an acre, 12 units, as Andrew mentioned. They're kind of like townhomes or row houses. It's nicely kept.
Are they all one beds?
No, there's 12 units. 3 of them are 2 bedrooms, 9 are 1 bedroom.
Okay.
Yeah.
A 1-bedroom townhouse. How do you even do that?
That's why I asked. It's not in there.
And it's like townhouse may not be the right word.
Yeah, but they're no stacked units is basically the idea.
Yeah, I've sold a few, and they're like they're glorified little condos basically. You walk in, it's got the kitchen, the 1 bed. Yeah. Just like what these are.
So we were talking before about what the highest and best use would be here.
Yep.
And your vibe is development.
Yeah, my thought with this is either the person who purchases it now, you're buying land that services itself until you can develop. Yeah. So you buy this, you go to CMHC, you let it cash flow until you do everything that you need to do to be able to get shovel ready.
And that's something that's been a very firm requirement of mine when I'm talking on my show. Like anybody who's thinking about doing development, especially a first timer, don't do it on one you're bleeding on the whole time. Do it on one where you can just slowly work away at it, get your approvals, you're making money the whole time, and then all of a sudden your property's worth a whole bunch more money.
I think that's a good standard for if you're new to anything in real estate.
Yeah.
Even if you're going to get into multifamily for the first time, best to
cash flow.
Get a cash flowing, hybrid or turnkey, as opposed to a full value add where you're getting kicked in the teeth every month.
Yeah, full value add is obviously tough, huge time requirement. So if you can do stuff where you can get in, you cash flow, you're obviously going to be you're going to sleep better, and that's the critical part.
Yeah.
And we won't go as long as we spoke about it last time, but one of the things we were talking about that you mentioned, Andrew, was there's the potential to Airbnb as you're doing this hold in between. And, with CMHC, there's potentially ways to get around that where you're able to have a company that's in there, and we don't want to tell you what to do. Make sure you're doing what's best for your situation, but there's multiple different angles with this property.
The angle you're talking about, which we went into this before, is that you could, because lenders don't like it, they don't, especially CMHC is not going to do a deal, but I've known of some people who will basically just rent rent a couple units to a company that they own, and then that company does the Airbnb. So then, as far as your annual reviews with your lender, everything looks normal. Because all the Airbnb activity is outside of that company. Now, whether that could still get you in trouble, of course it probably could. So, you got to make your own decisions, and, we'll leave it at that.
Exactly.
We're not recommending anything, just an observation.
Yes. Yeah. Anything else for yourself, or can we get right into it?
No. I think we were talking about Airbnb arbitrage, right? Like, so if you went out and, fill these and they're all $2,000 a month and you fill them at $3,000, you could still go to CMHC. They're just not going to finance it on $3,000 a month. It's going to be on $2,000, right? So if you cherry picked a few units and, you're sort of bound and you're tied up at $2,000 and you're bringing in $3,000, that's not a problem.
Yeah.
It's just you're probably almost certainly not going to get the financing if your income is that much higher.
So CMHC, you think would still allow for it? I mean, once you already have the mortgage in place, I don't think you're going to have any issue.
Yeah, I don't think you're going to submit to them. Like, you're not going to say, hey, I'm going to Airbnb these. But once you get the lending in place and then you turn around and somebody comes along and Airbnbs 3 of them.
I don't think that's an issue at all.
I'm confident it's not.
Yeah.
TBD, fact checkers, please. Please let us know.
Fact check through experience if you want, if you feel so inclined.
So as what I mentioned at the beginning, so this is a property that on acquisition using CMHC underwriting values, you're above a 6 cap. We went a little bit under the purchase price just because, there's always a little bit of room for negotiation on stuff.
You would assume,
You would assume, I'm not saying they'll take this, but this is kind of just how we ran our numbers. And so finding something on market in an area where the sellers are being, in my opinion, pretty close to realistic. Mind you, I haven't seen the inside, so I don't know what it looks like if it matches up. But just from numbers alone, it looks to be a pretty good deal. And that's why we have it here.
And you're figuring stabilized numbers. I know you're adjusting some of these. Most of them, you're just going with what current rent is.
Yeah. So what we do is if it's within $300, we'll leave it as is. It's not worth the jump to try and bring that up. But if it's more, then we will.
Yeah. Okay.
Exactly.
Makes sense. So what's the total lift here that you potentially have to go up to market on these units?
If you were to do everything up to market, you probably have.
I think you just got to sum up the spread line.
Yeah. So like we have doing it this way, there's a difference of, $4,000 a month in income or like $700,000 on the actual property itself. But if you were to do, blank slate, everything to market, you'd probably be able to get over 3, I believe. Like I think a fully stabilized building in this area for $200,000 a door, or sorry, $250 a door isn't unrealistic.
Yeah, because you've got a 575 cap exit, $231 a door. This is the process here, guys. Like we'll take this, funnel it down, run the numbers, and then we go see it. Yeah. Right? So all this is kind of open to interpretation.
You got to crunch your numbers first.
You got to do that first, right? So we see 1,500 of these a year on average, and how many of them are worth talking about, and then how many of those are worth actually transacting on. But presuming that they're solid 1 beds. And the inside's pretty good, and we get those rents. I think 575 cap might even be, too high. I bet you we could get, like on a refi basis,
you could probably get it a little, if you were to go through, you could probably get that lower.
Yes, and for those who are not familiar with that, cap rate is just basically your rate of return pre-financing. So as a seller, you like a really low cap rate. Buyer, you want the really high cap rate.
Exactly.
I had this chat today too, was the difference between value on a sale and a refinance. All right, so I think if you take this product, we stabilize it, right? So now it's $3 million, and we go to refinance it. I'm quite confident we're going to get at least a 5.5 cap, maybe even lower on a refinance. But if you go to sell it, I'm not sure you're going to get that in today's market because there's less people purchasing something like that. So it's a moving thing that happens, and sometimes those things are not exactly in line. In fact, they're often off, and sometimes it's one above the other.
Yeah, because an appraiser's job, like it's so theoretical. Like, if there was the right buyer here, it's worth this. But what if it takes years to find that right buyer? Like you just
in a seller's market, often that's going to shift. Right, you're seeing appraisers, and the appraisers are pushing the value down, and you're arguing, saying, "Hey, I can turn around and sell this for $4 million bucks." Right now,
and then they can't justify it.
Yeah, correct. Yeah. So in any event, that's the difference we're talking about. But if you're exiting this in today's market, I think exit with a refinance, I think you're going to get at least a 5.5 cap.
Yeah. So in your head, Dave, it would be go in straight to CMHC or do little rentals if needed, then refi with CMHC. and then you would just go through and work on the development.
The way I'd start is have a chat with the agent, see if we can negotiate the right to close this with CMHC debt on it. So you're conditional for 30 to 45 days. You do your typical due diligence, and then we firm up, and then we basically get, call it 4-ish months to close. So we're going to go and get you the COI from CMHC. Once you have the lending in place, you close with CMHC debt. So easier, cheaper, just takes a little longer.
Yeah, it takes a little longer. What's COI mean again?
Certificate of Insurance.
There you go. Okay, and that's for CMHC specifically.
It's basically
so you go straight to CMHC for that. If you don't deal through the lender, you go straight to CMHC, get the COI, and then you just take that to the lender you're working with. You got it.
Yeah, because a deal like this, if they force you to close faster, then you're going to have to get what's called a bridge, right? So it's just you're going to end up in the same place. It's just going to cost you more money. So part of being on the agent side is, hey, if you're going to go to CMHC, why don't we try to get you the time to do that before you close and save you that cost to do the bridge?
Which was never a possibility a couple of years back, right?
You wouldn't even discuss it. They'd hang up on you. And now it's, it's interesting though, to kind of circle back to your comment, Brad. This seems at least objectively like a very well priced product. And we're perhaps starting to see that a little bit more. So we may get into situations when people are doing this where they're not going to give you the time.
Yeah.
Right.
And the one thing to kind of back that up a little bit more, if you're a buyer that, the only way you would close is if it goes CMHC and you can't get that 100% kind of confidence in it. We've had conditions that we've kind of built in where, you do your standard due diligence within 30 days, and then you have another one that's specific to CMHC financing only. So like you're conditional-ish to the point of it's what we call true precedent condition, I believe is the term that we've worked with our lawyers, where the only thing that could stop this deal is if you aren't able to get the certificate of insurance. That's it. And you're able to back out at that point. So there's ways, because like no one's going to give you a 120-day conditional period or how long to get the CMHC financing.
I can tell you guys, like in the States, like in Florida, when we're doing deals, like anything that involves financing, it's up till the day of closing. If for some reason the lender backs out, the buyer's off the hook.
Wow.
Yeah. And that's just the way it is. Wow. So it's not like Canada where you get your 5 days, your 10 days on residential. It's like right up until closing. So that's why it's such a different culture down there. When you say it's a cash offer, that means so much more.
That makes so much sense.
Yeah. Yeah, because you literally can't.
That was school right there. I didn't know that.
Yeah, you can't legally, like, I mean, at the end of the day, you could write a cash offer and try and get financing and show up to the title company, and what's the seller gonna say if the buyer uses a loan but didn't like put it in the contract? They'll be fine, but it's less common to see that. If you're cash, you're cash.
Wow.
Yeah. So very different culture down there.
So we got to build it in. Like to Brad's point, the true precedent that we put in, we'll even sometimes specify not only do you need approval from CMHC, but it's got to be 85% loan to value with a rate of no more than X. Right?
That makes sense. You can build these things so then you effectively have the same thing that they do in Florida, where you got protection. If you don't get that, everybody's in agreement. Yeah, we should get these terms, and then the seller kind of takes the risk with you.
And we're in this place in the market where we can do that, right? Yeah. And it's allowing. That's why I'm saying, like, why we had this podcast is there are really good deals out there. You hear it all the time that nothing cash flows. And it's like, well,
Well, on that note, let's see it. Let's see the numbers here on the cash flow.
So this is going straight to CMHC. We see the purchase price up here, and we are using 85% loan to value because our debt coverage, our debt servicing rate is above 1.2. So we have buffer zone here. Assuming a 4.5% interest rate at the time that we ran these numbers. Of course, things can always change, but these are just the assumptions that we're making right now. So to be able to get into a building over, at $2 million, you're getting into 12 townhomes, row houses, whatever you want to call it, for less than $400,000 all in.
Okay, so $2,400 a month, what is that? $25,000
a
year. Yeah.
So $25,000 a year. And you've built in a good amount of expenses, right? Property management, salaries is grass cutting and snow removal, maintenance, all the fun things. And on an investment of $400,000.
Yeah.
Yeah. Less than $400,000. You have a property when you take in your cash flow, your pay down, and your appreciation of 32% ROI, 32% ROI from day one.
32% ROI?
When you're taking into account what your mortgage pay down would be, assuming 3% appreciation based on rent increases and your cash flow. Yeah.
Well, you don't see that too often these days, and this is an on-market deal.
And that's why we wanted to show it, to just say there's still lift here, as we said at the beginning, and there's still other opportunities to bring the value up. There's no parking income. There's no
So that's
many
the
other
gravy.
ways.
Yeah, and so you're about a 6.25% cash on cash. With solid. That at the 25,000. So which you can improve. You could probably get that up closer to 10 or maybe 8 by doing some of that stuff. Charge for parking. Other ways to monetize.
Exactly.
Depends on how much you want to roll up your sleeves and really implement things.
But these are the deals where you can just set it. You're making a good amount of money. If you did nothing else, you're in a good spot.
Yeah.
And then you can start picking away at it piece by piece to increase the income. It's a good deal.
That's the one thing that I've seen over the last 3-4 years is the people that are actively buying and still doing that is they're taking stuff a little bit safer. They're not over leveraging. They're not getting their hands. They're not going too far into it when there was uncertainty. So have this and just slowly work at it. If you want to get into the multifamily space, but you don't want to do something complicated, something like this is perfect.
Yeah.
All right. So question for both of you guys. If you were to want to go to next steps on this deal, what would be some of the, things you'd be focusing on from a due diligence standpoint that you'd want to confirm or, given what you see here in the building that you think is something that needs attention?
Well, first, obviously, go through it. That's obvious, but environmental's a must.
Yeah.
We got to be doing those. Yep. I do them on any deal.
Makes sense.
We're doing that all the time. I'd like to review the leases. I'd be curious to see how many parking spots are actually connected to the leases in terms of, we've
if they're given parking,
If they're giving parking away, if it's attached to the leases, or can we start charging for it? And then the obvious one, too, is just sitting with a mortgage broker that knows this stuff so they can quantify some of this stuff. Like we've got 4.5% interest rate, which I'm pretty confident in. Yeah. But I do know that lenders are starting to be a little bit more restrictive to lending on deals below $2 million. Yeah. So, just making sure that those are there. But
yeah. Mm-hmm. And then the only one thing I would add, of course, you want to go through the units and you want to do everything, but there's always just that extra level of care when you're at a property that's close to the water of just with seasonality that happens. And I've heard, I don't know what Wasaga Beach is like, whenever anything is close to the water and there's wood, you got to watch out for ants. So it's just having that kind of increased inspection that any inspector should find, going through all the properties, or all the units, checking it out.
Yeah, and I think that's a great point. And the other thing, too, is just trying to understand the market, Wasaga's market. And I think we touched on the first part of this, but what's going on there? They've obviously got the casino. What's driving the economy out there, and what is our long-term belief on that?
Making sure there's more than just one employer. We talked about that before. I think that was in our previous take.
It's all blurred into one.
Yeah. So obviously that's one of the questions I asked Dave before is just as a small town investor, the things you look for. My feel on it is, if it's been there a long time, it's probably still going to be there. However, of course, you want to watch out. Is it a dying industry? If for some reason nickel mining was no longer going to be a thing, you might not want to invest in Sudbury or Sault Ste. Marie, right? Yeah. So just stuff like that, where you want to be aware of, are they overly dependent? I mean, up in that area, is it still Hydro One that's the employer, or is that too far?
I'm not sure.
Yeah. So
I think they still have, in that area a little bit.
Yeah. So just kind of keeping that stuff in mind, but big government energy employers, for me, I'm not really that concerned because it's not going anywhere.
Yeah, and just trends, right? Is the population? It's 25,000. Is that going up? Is it going down? Fine. How many people? What's the?
You'd have to assume it's been going up, but would the impacts of immigration being shut off for the next couple of years change things? Are more people going to go back to the big cities, or are they going to continue to enjoy the cost discount to living in communities like this?
Another fun one we looked at a deal in Ayr, Ontario, and we looked at the average income in Ayr. It's back then, anyways, it's 2 years ago. It was very, very high, and then you start driving into why and all these mitigating particular reasons. It's quite interesting. So I'd just be curious about that in Wasaga as well. So
and is that type of data relatively available?
We can get it. We got that from some of our programs. I'm not sure if it's
you can't go on StatsCan and pull that stuff.
Yeah, I don't know. I think perhaps
there's some, but it's usually lagged. Like it'll be from a while ago.
We can get a lot of stuff, new construction starts, all these really how many permits have been pulled in the area. Like, it's some really cool data. So as you start to enter into these secondary, tertiary markets, there's, you know me, I'm pretty data driven, but if you start funneling in all this data about it, you start to see a pattern, right? That's what I did in Bruce Powers. Okay, these trends are all going towards a good, progression. I would just do the same thing for Wasaga. It's just pull as much as I can and try to understand as much as I can about what's going on. I'm pretty confident in it, but I'd be a lot more before I firmed up on the deal.
That's why you got to do diligence period. So
that's what it's for.
Without knowing any numbers, I do know that I've seen over the past kind of 6 months and a year, Wasaga Beach is putting a lot of money into developing themselves as a city and trying to separate themselves from being the beach town or the beach city.
Right.
Like they're putting money into new, like the casino is relatively new developments, new construction. It's all going up there.
To a certain point, and I've said this for a long time, like if you got the infrastructure, it's so expensive to put in infrastructure for streets, sewers, utilities, all that stuff. So existing towns, it's like hard to imagine that they're ever going anywhere. I mean, of course you could see like decreases in rents because there's less people trying to rent, but when we're in a day and age where you're still buying stuff mostly under the cost of rebuilding it, that right there speaks volumes.
Yeah, agreed.
Yeah. Anyways, okay. So I think that wraps it up for this one. With that said, the REI Hot Seat Insiders list. If you want to be on that, you gotta join that through the link attached to this podcast or video. It'll be under the video or in the show notes. Join up. That basically gets you onto the mailing list, so you can start getting off-market deals that these guys get in their office, and then also gets you a conversation with either yourself, Dave, or one of the members of the team.
Yep. And we've taken. Did a bunch this week of new intake calls with people that are looking to buy, and a few of them were single family and duplexes. Owned a few of them and are trying to get into multi. So it's been good. We've been helping a lot of people.
Nice. And if you're a seller, same thing goes. Obviously, the benefits are going to be in there.
Yep.
And you can have chat with these guys about that. That stuff
and if you're a seller, we can put together a pro forma that looks like this. Relative to your property, to give you an understanding of what it would be to be the buyer side of the transactions. You can understand what we are confident that we could get you as a sale price.
Yeah, it's understanding that whole process makes it so much easier to know what the value would be.
Sometimes it's helpful because people say, hey, look, I want $5 million. You go, great. You run the numbers. You show them what it's like to be the buyer, and they go, oh, that's never going to happen.
Would you buy your own building?
It's helpful, right? Because sometimes you don't know what you don't know, and then when you go through this exercise, you go, okay, I see why that would make a lot more sense at $4 million.
Makes sense. All right, guys, if you enjoyed the content, please show the channel some love, share it with somebody you think it could help, and we'll see you again next week.